So last week, Ford Motors released its financials that for the first time shows how its electric vehicle business unit is doing, and it's not looking good. In today's video, we will review how well Ford, GM, and other car manufacturers are doing in their efforts to create and sell electric vehicles to the car buying consumer who is increasingly no longer wanting the traditional gas cars and opting instead for the electric vehicle models. Will Ford be able to survive? Will any of the legacy car manufacturers or the new EV startups like Rivian and Lucid be successful? It's a big question. And as you will see, so far they are all struggling, except of course Tesla. The difference is even more clear when you see the financials and sales side by side. We are joined today by James Stephenson, who is a financial analyst that closely follows the auto industry, and he will review with us some of the key metrics that will show the health of their business. In fact, he'll show us the cash flows for 24 companies. So let's step back a bit and review some background. While we'll mostly focus on Ford, only because they're one of the only companies that has been transparent enough to finally show the details of their EV business unit, we'll also be showing metrics for a number of the other competitors. Ford Motor Company is a multinational automotive business founded by Henry Ford in 1903. With its headquarters in Dearborn, Michigan, it's one of the largest and oldest car manufacturers in the world. The company produces and sells a wide range of vehicles under various brands such as Ford, Lincoln, and Mercury. Ford is known for a number of its iconic models, such as the Mustang, F-150, and GT, and a history of innovation in manufacturing and production, including the introduction of the assembly line. Last May, Ford President and CEO Jim Farley introduced a bold plan, very bold, but in my opinion, a necessary plan, the separation of the company into three distinct business segments. The Ford Model E segment focuses on the EV business, Ford Blue covers Ford's traditional car business, and Ford Pro focuses on commercial customers. General Motors is also a multinational automotive company and founded in 1908. GM sells a wide range of vehicles under various brands such as Chevrolet, Cadillac, Buick, and GMC. GM is led by Mary Barra, who has been very vocal about being the leader in electric vehicles. The key question for her and the other leaders of the gas car companies is how do you exit a business that currently accounts for nearly 100% of your profits? Welcome, James. Thank you for joining me, and thank you for helping me answer this question.
Absolutely. My pleasure to be here. Thank you for the invitation.
Thanks, James. So as I mentioned earlier, James is a financial analyst and Tesla investor. James has 145,000 followers on Twitter and a successful YouTube channel. He's one of the few that does deep research with very smart financial analysis and insights. Many follow him on Patreon as he shares these analysis, very important to the Tesla investor. All right, let's get brighter. Okay, so James, thank you so much for joining. I had seen you present and share this incredible slide, which I'm going to show right now. I think it's pretty cool. This is the first time. Oops, here we go. It's the first time that I've ever seen anybody compare all 24 auto manufacturers together. And this is just a really incredible slide. Can you tell me what we're looking at here?
Sure. Thank you again. And thank you for that glowing introduction. I appreciate the compliments. Operating cash flows are super important. They get overlooked, right? People want to know about the units. People want to know about revenue. But the operating cash flows are the lifeblood of your company. That's restricted to only the kinds of transactions that are the primary business that you're in. So in the case of auto manufacturers, we're talking about what kind of money are you making creating stuff and then selling that stuff to people, right? In Tesla's case, they make more than just automobiles. They also have Tesla energy products and services, et cetera. So when you look at the operating cash flows by automaker, it can be pretty revealing. There's a lot of big companies here who are moving a lot of products. Many millions of vehicles are sold every year by GM, Ford, Volkswagen, BMW, Mercedes-Benz. Stellantis is the parent company for Dodge, Ram, Fiat, Chrysler. A lot of big car brands. Of course, Toyota is on here. But nobody is really running away with the operating cash flows if you look at it. And a lot of
Mhm.
companies have really small or actually negative operating cash flows. So I thought this would be a good way of visualizing a comparison between 2 dozen automakers all at one time, with some of these still pretty early in their ramp and actually at negative operating cash flows. Companies like Rivian, Lucid, Polestar, Arrival, Faraday Future, extremely small cash flows right now. So these companies need to go borrow money or sell more stock if they want to continue their growth because they have no money to pay for their capital expansion otherwise.
Okay. Wonderful. So, yeah, by looking at this, you can see in terms of cash, Ford looks like it's actually, it looks like that it's, so first of all, let's clarify. This is a comparison of all cars, not just electric vehicles. It's their business unit, correct?
This is the total corporation's
Yeah.
operating cash flows. Yeah, so the whole company's business for each of these. So I'm not using adjusted or company adjusted free cash flow here. I took all of these from Yahoo Finance. So it's
Mhm.
the whole company's financial statement.
Okay. So it looks pretty good in terms of Tesla. It's growing from nothing to, becoming pretty significant at this point. GM seems to be flat. And, if you compare the cash flows for where Tesla is today, it looks like they're almost basically at the same level as GM or Ford is. Toyota is still doing incredibly well. So is Volkswagen comparatively. So this is just comparing an upstart Tesla against an existing, um, vehicles, right? Okay.
Yeah, and keep in mind, Tesla sold 1.3 million vehicles last year. Most of the
I see.
companies that you see that have big operating cash flows last year made that money selling millions of combustion vehicles.
Oh,
That's
gotcha.
not how they're going to be able to make money in the future because the world is transitioning to electric vehicles. So these old laggard C automakers are going to have to get real good real fast at making electric vehicles if they want to continue producing these operating cash flows because the well is running dry.
Gotcha. Okay, now that makes it clear. So this is like comparing it to who's selling 10 million cars per year, 10 to 12, and Tesla's only the 1 to 2, and yet we're catching up in cash flows. Okay. And
Yeah,
then
almost none
sorry.
of those
Yeah.
Toyota cash flows are coming from battery electric vehicles. They make a bunch of hybrids, but as of yet, they don't make very many electric vehicles at Toyota yet. They're going to have to get real good at that real fast if they want to survive the next decade.
Okay. And then this is the free cash flow.
Yeah, I've got one here for free cash flow as well. So the difference between operating cash flows and free cash flows is that you have to subtract all of your capital spending from your operating cash flows to see what's left. How much money is your business generating after you have funded your capital growth and maintenance for your company? So this is the money that you have left uh, to do other stuff with. If you want to be able to fund um, acquisitions of other companies, if you want to be able to pay dividends, if you want to be able to buy back your stock, you want to be able to do that from free cash flow. If you don't have the free cash flow, or if you have negative free cash flow, now you need to go find money. You've got to go raise cash. How do you do that? You can borrow it from a bank. Um, these days, the interest rate environment is very unfavorable. You want to do as little
Mm-hmm.
borrowing as possible at today's interest rates,
Mm-hmm.
or you can sell more shares of your company's stock. Most of these companies' stocks have been beaten up pretty badly. They probably don't want to raise at today's valuations. For example, GM and Ford are about $45 billion valuations each today. Tesla's still at a $600 billion valuation, even after the bear market of 2022. So, yeah, a really enlightening chart here for anybody who's thinking about investing in Rivian or Lucid or Polestar or Faraday Future. Those companies are not generating positive free cash flow yet.
Mm-hmm. Mm-hmm. And then look at down here, right? The Chinese companies, Xiaopeng, Neo, Li, BYD, they're all struggling as well. They're not quite profitable. They're not making cash. BYD just is very small, and they're probably going to be supported by their government. But yeah, they're a competitor. Not saying that to not to think about them, but they're not like running away competing at this point.
Yeah, I wouldn't get too down on BYD. Those are respectable free cash flows from them for now,
Yeah,
and about half of that is coming from selling battery electric vehicles. They still sell a
right.
whole lot of hybrids at BYD, but they are making compelling electric vehicles at lower price points than Teslas sell at, most of them. They do have the BYD Han, which is a luxury vehicle, but most of their EVs are in a lower price segment.
Gotcha. Okay. That's no, those are amazing charts. I love these, James. And I was saying to you that I'd love you to create more of comparison of all 24. This is the first time I've ever seen this. You need to do more. You got to show me in all the metrics.
I got to find the time to do it. I've got limited time to devote to Tesla related endeavors because I am still working a full time job Monday through Friday. So I really only have weekends to work on Tesla stuff.
Okay. So let me show you this. This is I love this deck here, and you can help explain what this is. So this is um, the global sales of all vehicles, and you can see that in the gray, this gray here is the ICE vehicle sales. This is the gas car sales right here, and then the electric vehicle sales is the blue right here, the blue. And so the concern is that if oh, there we go. I'll go to the previous one here. That if you add the projection of the ICE sales, if they fall faster than we realize, so here's 2023, we're right here at this point, and we have seen peak ICE vehicle sales already, as you can see here, and we are seeing it fall. But if it falls faster than we realize, and EVs are not able to kind of catch up, which is in the blue, that green area is the kind of like demand that's out there. That's the demand that people are wanting, but there's going to be a valley of death. So this speaks a little bit to what's going to happen to all these car companies who are producing both ICE vehicles and electric vehicles.
Yeah, or the companies that are producing mostly combustion engine vehicles still, even though they've had a decade's advance notice that electric vehicles are coming to disrupt the fossil fuel industry. If you look at consumer data, study after study shows that most people want their next vehicle to be electric. So if their next vehicle purchase comes in 2 years or 3 years or 4 years, they're going to be deciding between electric vehicles, looking at um, every comparison shopping metric they can find. What's the best for safety? What's the best for range? What's the best for efficiency? If I want to take it on a road trip, is there a quick charging network that's convenient for me? Um,
Mhm.
what kind of autonomy features are available, and they're going to pick one based on what they think is the best value for their money. People are spending their own money. They're going to research that decision pretty well, and they're going to pick whatever EV they think is the most compelling. If you're an auto manufacturer who's still hoping to sell fossil fuel vehicles at the same levels you have in the past, good luck to you finding buyers for them as the years tick past.
Okay, but this is sources General Motors for the actuals, but then the projections is from JPR 007, and he's the one that's putting this projection here. Do you believe this? This seems a pretty aggressive of how fast the demand for ICE vehicles, the gas cars, is going to fall. We're here 2023. It's going to look like it's going to be gone in 3 years. That's a little bit too much, right? I mean, it's going to be probably certainly not 2050, but 20. It's probably 2035 when we start seeing more and more of these countries and states putting in these laws that they really want 100% of all sales to be electric vehicles at that point. Most of them are 2035.
Well, it's a hotly contested issue. The best person to ask about this chart would be JPR 007, who's been doing a great job putting his projections out for years. He's been right directionally. Now, the first rule of forecasting is whatever you forecast, it will be wrong.
Yeah.
So nobody's going to get the timing exactly right, but companies like BMW, who say they don't think the majority of sales will be electric until 2035. They're just wrong. In
Yes.
Norway already, we see 80% of new vehicle sales are electric. Now, they've got government incentives in place that make it a lot more expensive to buy combustion engine vehicles in Norway than electric vehicles. But more countries are going that way, incentivizing electric vehicle sales. We've seen here in the US this year the Inflation Reduction Act um,
Gotcha.
providing benefits to buyers, a $7,500 EV tax credit available for most electric vehicles in the US this year. And even without those incentives, people are increasingly drawn to the benefits of electric vehicles over fossil fuels.
Yeah. So what is your estimate though? When do you think that ICE vehicles will, get to, let's say, 50% of their height versus EV
Uh,
sales?
well, I just said BMW was wrong that it'll be 2035. So,
Hmm.
I won't be surprised if 5 years from now, so in 2028, most
Hmm.
vehicles sold are electric.
More than 50% of vehicles sold will be electric in 5 years from now.
Well,
Wow,
so
that's a
it'll
huge jump.
depend
Yeah.
on, yeah, it'll depend on if the cell capacity is there. The factories need to exist. So
Yeah.
Tesla has done a better job than other companies have of securing cell supply through companies, partnering with companies like Panasonic, LG, CATL, and then doing a lot of investment in making their own 4680 cells.
Yeah.
So I think Tesla's going to be okay to expand at that rate and put a lot of really good electric vehicles on the market. And I have high expectations for Tesla being able to sell every vehicle they can make over the next 5 years for sure.
And I think that's what this slide talks about, right? I mean, this is the blue, which is electric vehicle potential projection of what it can happen. Here we are, 2023, and like the green is a demand, and so Tesla is going to be just one piece of this, and all the other companies need to start producing more EVs than they are in the gas. If the gas cars need to fall, and then there's going to be this value death, which is this demand is going to be so much higher. So that's why it's very obvious that Tesla will sell every car it makes. And then the question is, can these OEM companies, can these gas car companies make that transition? So before we answer that question, why don't we talk about kind of the health of these car companies? Oh, this is Martin Viecha, who is the kind of the investor relations person for Tesla, said this, which is he just said that what if ICE sales collapse well before the EV capacity grows to a level of, say, 90 million per year, a period in which there are not enough electric vehicles to go around, but it doesn't make any sense to buy an ICE anymore. And I think, like you said, it's happening now. I'm hearing more and more people anecdotally just basically realizing that if they buy a nice car today, in 5 years, 10 years, it'll be worthless. And so, that's where they're headed towards. Okay, so this is an incredible table that's created by our friend Alexandra Mertz. She's known on Twitter as Tesla Boomer Mama. She was an ex investment management firm at Moody's and her investment firm. So this is a table she wrote. And do you want to explain to people what we're looking at here?
Definitely, yeah. So this is the best illustration I've seen on what sets Tesla apart from the other automakers. Why does Tesla have so much higher market capitalization than other companies? People will look at unit sales and say, oh, uh, there's no reason Tesla should be trading at a market capitalization or a valuation of $600 billion when other competitors are selling so many more vehicles. Well,
Mm-hmm.
the other competitors are shown at the bottom of this screen. This is color
Yeah.
coded. Green is better. Tesla is the best
Yeah. Let me
among
go
not
ahead and
just other
just set the
automakers.
stage. Yeah.
Yeah.
This is the top largest companies in the world. And right now you can see that it's Apple, Microsoft, right? Google, Amazon. And Tesla's number 6 in terms of market cap of $677 billion. But if you compare kind of the health of the financials, and this is kind of the way to do that is you look at this, and these are the the one way to look at it's whether or not it's worth investing in this company in terms of its investment grade credit rating. And you can see that um, uh, Tesla, which is number 6 here, best, second best, 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 best. And then the question is, why are they not yet AAA in terms of investment grade credit rating? So they're a very healthy company, very healthy company. In fact, healthier than all even largest market cap companies. But down here, we're looking at it compared to all the other car manufacturers, Toyota, Mercedes, Volkswagen, GM, and so forth. And if you look at their health of their company, they're nowhere near green. They're all very, very poor in terms of their, debt to debt ratio, cash flow, and all that. And that's what we just showed here, that they're in trouble. And yet they're still being given good investment grade credit rating when in reality, they are like right at the bottom in terms of their health. Yeah.
Yeah, and they are dependent on the capital markets for their continued existence, right? They need to keep going back and borrowing money. Tesla does not need to keep going back and borrowing money because Tesla's been operating cash flow and free cash flow positive for so many years now. They've been using that extra cash to pay down their debt early, which is why all their debt metrics look so good in that table. That's how they can be the best or the second best on things like
Okay.
cash to debt, debt to equity, etc. They just don't have very much debt left over like most of the automakers do.
All right, wonderful. So let's go ahead and what should we do next? Continue to compare this against other car companies, or should we focus on Ford, which just released their financials?
Yeah, I did put a couple of charts together comparing Tesla against Ford and GM. I was just talking about debt a second ago.
Mhm.
Uh, in 2018, it looked like Tesla was going to just continue increasing its debt like we've seen other automakers do. Every year they would borrow more and more money, and their long-term debt total would continue to rise over time, as we saw GM do from 2012 through 2018. But Tesla, as they became profitable, started just paying down that debt early, retiring that debt before it came due. And now Tesla has almost no remaining debt. Whereas if you look at Ford, they've had about $100 billion
Wow.
worth of long-term debt every year for the past 12 years. Only the past couple of years, they got that paid down a little to about 90 billion. Why did GM start off so low back in 2010? Because the last time they went bankrupt, it was 2008. So when they emerged from bankruptcy after being bailed out by the U.S. government, they didn't have a lot of debt on the new GM. But
Right.
since that time, they've been doing what normal automakers do, borrowing more money every year so that they can front their purchasers the money to buy the car and then get paid back over time through their financing arm of their automaker. That's what most of their debt is for. Also, for loaning money to dealerships to buy the cars from them. So you've got consumer financing and you've got dealership financing going on from both Ford and GM. Uh, Most dealerships do borrow the money when they buy cars from Ford and GM and then pay it back once they've sold the car. So that's
Wow.
a good business model so long as it works, so long as you don't enter, let's say, a high interest rate environment where your old debt at a fixed low rate is now selling at a huge discount. That's not great. And what we've seen from some of these automakers is that they're limiting their production of new vehicles to try to keep the existing fleet of leased vehicles resale value high. So we've seen more and more evidence of that, including in the earnings release from Ford last year, where they admitted on their financing waterfall page um, that that's one of their strategies. Not just them, but Hyundai Kia also came out and said that recently, that they've been limiting production to prop up the value of their leased vehicles so that even if people default on the payments, they'll be able to resell them at and recoup most of their loss.
Yeah. So you just said, I think we should pause here and let's just go right out right now, and then we'll back it up with even more data later. I just think we just go right out, say it like, how likely are these companies? Let's pick some of them. How likely they're going to survive? And so you just said that in this case, you showed a graph showing Ford and GM's debt. And what many don't understand is that many of these ICE car companies already are just massive debt now, high interest environment. They're going to be suffering, paying more. And you just saw Alexander's table showing that they're already bleeding in terms of their debt ratio and so forth. And you showed just a few minutes ago cash flow. They're struggling. And that's just one. And then you talked about how they're selling it to dealerships and the financing issues. And these are all coming to fray this next few years, next 5 years. What is tell me the list of things, what you think of their health, if you're looking at them objectively, the ICE car companies, and what's your prediction?
Well, corporations in general do not like a high interest rate environment. Companies like to borrow money on the cheap. And as long as those conditions are present, it's easier for companies to make money because they can borrow at a low rate. And then even if their company doesn't make a very good profit margin, their profit margin is probably better than the rate at which they borrowed. So they can profit from the difference, and it makes sense to borrow more. Or at least that's the traditional way of thinking. That's how they teach you in MBA school, is as long as your cost of borrowing is less than your internal rate of return, it makes sense to borrow. And that's how these companies end up with so much debt in the first place.
Mm-hmm.
Uh, I don't think I have any special ability to call out which automakers are going to go bankrupt
Mm-hmm.
over the next decade. I think it's likely that some will. There's a reasonable case to be made that Ford or GM are going to need some assistance to make it for the next 10 years. If the economy stays in the same shape that it's in for very long.
Yeah. Okay. Well, we're showing the numbers right now, and we're showing the numbers are not looking good for these guys and all these other issues that are happening. Let's go ahead and share some more information that you've got here.
Sure, yeah. So that was the long-term debt chart. Here's the
Yeah.
revenue chart for GM versus Ford versus Tesla. You can see Ford and GM, about between 128 and 256 billion dollars. Why does the scale do this? I put it on a logarithmic scale so that you could see how low Tesla started out. 117 million dollars worth of sales back here in 2010, back when they were only selling the original Roadster. And then as they introduced the Model S, that revenue grew to more than a billion. You know, every time you see the line pass one of these
Mm-hmm.
horizontal lines, that means that
Mm-hmm.
Tesla doubled their revenue. So from 2 billion past
Mm-hmm.
4 billion, past 8 billion, 16 billion, 32 billion, 64 billion. This is a really obvious up and to the right trend,
Mm-hmm.
even on a logarithmic scale. Whereas Ford and GM revenues don't appear to be growing any. They took a little dip here for COVID and for the chip shortage and supply chain challenges that happened in 2021. But they're really only back to where they started 12 years ago at the top line, the revenue line, because they've been discontinuing their least profitable products as this time goes by. There's a lot of sedans Ford and GM used to make that they no longer make because the profit margins were so thin on those. They killed off those programs so that they could have more of their sales mix come from their more profitable pickup trucks and SUVs. So they're not growing the top line, which isn't good for your chances of growing your bottom line profitability. I'll skip ahead to the next slide here. And I've used the most charitable numbers I can find for
Mm-hmm.
adjusted automotive free cash flow here. This is excluding the financing arms for both of these companies to look at just their automotive free cash flows. And so Tesla, you can see, has a very obvious up and to the right trend since bottoming back here in 2017, which was a pretty bad year for all three of these companies. They all went down from 2016 to 2017. Since that time, Tesla has been up every year since, and GM and Ford have had um, some ups and downs over the past 6 years, I should say. So that's just another one of the charts that I put together. And I'll finish with this last one, the fourth one. This is earnings per share. It's a little bit of a chart crime to chart earnings per share because the number of shares issued by each of these companies is different. But that was what John Engel at Almington Cap on Twitter requested of me 4 years ago, back when I labeled GM over 2018, back when the most recent information available showed that Ford and GM put out positive earnings every year and Tesla put out negative EPS every year, right? The other thing I noted on here is that I have adjusted the EPS to exclude the 5-for-1 split that happened in August 2020 and the 3-for-1 split that happened in August 2022 to show, okay, if Tesla hadn't done those stock splits, what would the earnings per share have been? And Tesla would be up to $55 per share if they hadn't done those two stock splits, which is, I thought, the most the most direct comparison to the question that I was being asked at the time, which is what I was updating these charts for. But yeah, Ford and GM are not growing their earnings every year, and this is what investors want. When you buy a stock, you're looking for a company that you think has really high odds of growing their earnings in the future. Every year, you want earnings growth. That's what you're paying for when you buy a stock. Tesla is delivering that earnings growth since 2017, and these other companies are not.
Gotcha. Yeah, I guess what was telling a little bit was, or unless I'm reading wrong, but if you show me again that same graph where you're looking at the total revenue, I guess what's confusing me is that Tesla's only selling, a run rate of 2 million cars this year. These guys have been in business for 100 years, as I said at the beginning. They're selling more than that, and yet their revenue's the same.
Yeah, so Ford and GM are selling, I don't know, 5 or 6 million units a year, something like that. And
Yeah.
Tesla only sold 1.3 million units in 2022 and still generated about half as much revenue as GM and Ford did, even at a much lower number
Okay,
of
gotcha.
units sold. Yeah.
That's an exponential scale there on the right. But yes, it still shows that their growth is exponential. So Tesla is going to quickly surpass this at any moment. And so not only is Tesla's business
Yeah.
strong, but these car companies are struggling. So, okay, maybe this is a good time for us to, let me share my screen again. And
Okay.
this is kind of like some statements from others who we follow in the Tesla Twitter community. Larry Goldberg is a respected kind of investor in Tesla and analysis. So what he said was, let's go back. Sorry, let me go back here. So he goes, I was roundly criticized in a closed forum for criticizing the Ford corporate EV strategy in their presser because Ford is currently earning $9 billion in profit, has gobs of cash on hand, and has a great runway to make the EV transition. So that's some people's opinion that Ford is going to be fine. They're doing just fine. They've got 9 billion profits today. They've got cash on hand, and they've got a runway. But his reply is that this is a reply. He believes that within 3 years, the classic Ford business is going to be bleeding cash. So this is what it is today. They've had losses of $2 billion and they're losing $22,000 per EV car they're making. And so the Ford kind of said, oh, that's just a startup, right? That's normal. That's what happens today. But Larry's warning that, 3 years though, as we said earlier, the classic Ford business, the ICE cars, the gas cars, they're going to be bleeding cash and it's going to be at an extraordinary rate. Don't people, never mind just analysts, see the rapid decay of the ICE business and their dealer networks? The Ford networks are probably bleeding cash already. Then he says here, there are going to be some spectacular bankruptcies and many Western governments are going to intervene, pouring enormous amounts of taxpayers' money down a bottomless pit. What's your reply to that?
Yeah, Larry makes the case pretty clearly, and he could be right. He's a smart guy. He's a very successful investor, and you know, it's true that a lot of startup companies lose money in the beginning. Tesla lost money for a lot of years before they started making profits, but it does not follow that just because you're losing money, you're guaranteed to make profits in the future. That's not true. And if you look at what the haters and the critics and the trolls have been saying about Tesla all these years, it's wait until legacy
Mhm.
auto flips the switch
Right.
from fossil fuel vehicles to electric vehicles, and they crush Tesla with their superior experience and know-how and their scale and their dealership network. They're going to apply all those forces to crush Tesla. Well, that's not happening at all. You can see in the Ford release, they're still losing a lot of money per electric vehicle sold as of last year. They're still pretty low in the production ramp, um, but you can't make money selling anything if your production output is less than your break even point. The break even point is determined by how large are your fixed costs and what's the gross margin per unit. For each additional unit that you sell, how much can you sell it for and how much does it cost you to make? The difference between those two gives you your variable margin per unit sold. The break even point is determined by those. So you've got to sell enough things to pay back your fixed costs before you can even break even,
Right.
much less make a profit. And Ford is way below that break even point now, and with probably an unacceptably low gross margin. So they have a lot of work left to do to try to take cost out of their electric vehicles. Uh,
Wow.
somebody left a tweet that said that Ford would have lost less money
Yeah.
if they had just bought Teslas and resold them, right?
Ooh.
On a per
Oh,
unit basis,
ouch.
they're losing, what was it, like $30,000 per car or something? I don't have
Right.
it in front of me,
Yeah.
but it's a big, ugly number. And they've got a lot of work to do to tighten that up and to get an acceptable gross margin, and then to ramp up that output without worsening their relationships with dealerships. You know, dealerships make all their money off service, parts and service on repairing cars that they've sold. People bring them back to the dealership for oil changes, and then the dealership recommends repairs and part changes and stuff, right? Electric vehicles have way fewer moving parts. Most of the stuff that dealerships are repairing doesn't even exist in an electric vehicle, right? You can't crack a cylinder head in an electric vehicle or have a fuel system problem or an exhaust manifold or a muffler go bad. They don't exist in the EV, right? So dealerships are not going to want to sell electric vehicles that they know they have very little hope of making future profits repairing.
Mhm.
Uh, so Ford has a dangerous tightrope walk trying to face the problem of um, selling less and less fossil fuel vehicles every year. At the same time, they're trying to design, build, and sell compelling electric vehicles.
Yeah. So I actually love a few things about Ford. Okay. Number one, they made this move, which is they started to, this was in May last year. They said that they're going to create three different business segments. So now they split the company up into Ford Blue, which is their existing gas car company. And then they created a new division called Ford Model E, which is their electric vehicle business. And then Ford Pro is their commercial business. And I love this because I think this is their way. This is their approach of how they're going to break themselves from the dealers and their existing factories and the burden of the debt that comes with Ford Blue and existing companies versus other ICE cars companies who have not done this. And so they are, it's like an albatross around their neck. Can you want to speak a little bit about that? Do you think that that's, what I'm saying? Is it true? Or is there some comments around that?
Well, a lot of companies like to restructure their divisions to try to separate responsibilities. And I think what Jim Farley is telegraphing is that he wants to be able to analyze the electric vehicle business on its own, separately from the traditional fossil fuel business, and to not have any of his uh, executives in charge of these areas uh, who have to make a decision about, do I sacrifice electric vehicles so that I can make more profits from my fossil fuel vehicles, right? If you separate out those responsibilities and you say,
Mhm.
no, I'm holding you responsible only for the growth of electric vehicles,
Yeah.
ready, go. Now you've got vice presidents in charge of production, operations, expansion, who have their incentives aligned appropriately to focus on the organization's priorities rather than next quarter's earnings. I hope that's what's going on. Also, he'll be able to better explain to investors, hey, we still have this profitable fossil fuel business, but we have an electric vehicle business that's showing some progress without
Yeah.
muddying those two together. Now they've already given out a warning that their electric vehicle business lost, I think, $1 billion 2 years ago, and like 1.8 billion last year, or 2 billion, and this year they're guiding to lose 3 billion. So
Yeah.
that's getting worse. Hopefully, 2023 will be their turning point, and they'll be able uh, to lose less money thereafter, and then at least break even in a few years.
Okay. Yeah. So what we just said is that they created a division called Ford Model E. I think part of the reason too is obviously to not have the same contracts that they do with the dealer networks, not have to be beholden to the union. There's a lot of benefits to creating a separate startup like an electric vehicle startup versus it being within the ICE cars. And then, as we mentioned, Ford the other thing I liked what Ford did was they were very transparent and they shared the actual financials for the electric vehicle business. And this is what we're looking at here. So here, Ford 2021, 2022, they basically said that they had 61 units sold in 2021, 96 in 2022. So they grew 57%. And then this is what happened to their revenue, electrical vehicle revenue, but the cost was significant. And so like this is what you just said, right? They lost about $1 billion. They lost 2 billion. They're projecting to lose 3 billion in 2023. So they're losing so much money per electric vehicle. And then this is how you compare it against Tesla. So if you look at Tesla's in 2015, uh, when they only sold 51 vehicles, and then by 2016, it was 76. So very similar in terms of what Ford is doing. But the big difference is that they actually didn't lose as much money, and they were actually gaining as they move forward. What's your analysis of that chart? This chart here.
Yeah, definitely. And I thank you to Forward Cap on this one. And then just before I forget to mention it, I think Ford's going to be stuck with the unions, whether
Oh,
they
I'm
transition to
sorry.
electric
Is that
vehicles or not.
I did not know this.
Uh,
Okay.
but yeah, Ford, those numbers up top are not good. Like, the revenue growth is fine. The 71% year over year EV revenue, that is what you want to see. The EBIT, the earnings before income tax, you don't want to see that number become a bigger negative number when you've
Mm,
grown your revenue by 71%. That is bad.
I
The
see.
EBIT margin got worse from 29% loss to losing 41 cents over every dollar of electric vehicle revenue they made. That's the wrong direction. You can see for Tesla, yeah, they did lose money in both of the comparable years, 2015 and 2016, when they moved a similar number of vehicles. But the loss didn't get that much worse. It got from zero point 0.9 billion to 1 billion,
Mm,
which is losing more money. It's losing 10% more dollars on revenue growth that grew 69%, but the EBIT margin improved. Instead of losing 25 cents on every dollar, they only lost 16 cents on every dollar. That is the right direction. You want your profit margin to improve as your revenue grows. And then the bottom section, which you haven't gotten to yet,
mhm.
is saying, hey, but why are we going back and comparing to 2015 and 2016?
Mm,
Ford is a big boy. They they put on their pants one leg at a time like anybody else. They have
Mhm.
known for 15 years that this
Mhm.
transition is going to come for electric vehicles, and they're late, and they should be penalized for being late appropriately. And the way to do that is to compare the same time period and say, well, what did Tesla do in 2021 and 2022? They moved way more units, and they grew those unit sales 40%. They grew their revenue from 52 billion to almost 80 billion, up 52%. Way larger numbers for units and for revenue than Ford is doing, because they've had so much time to scale because they started early enough. And then with EBIT margins of 10% improving to 15%, up 525 basis points, that is pretty great. That's how you want it to look when you run a business. You want to see your EBIT grow from 5 billion to 12 billion on that kind of revenue increase.
Yeah, the competition is not coming. And can you confirm with me the statement that there is no car company today that's able to create a profit on their electrical vehicle manufacturing and sales, except for maybe Tesla and BYD with just small amounts of profit of $1,000 or $2,000 per car?
Yeah, BYD's profits are pretty thin, and it's hard to dig into their weeds enough to be able to tell what the electric vehicles are doing separately from the hybrids and their other businesses. They sell electric buses, for example. Um, Probably they are profitable selling their battery electric vehicles. We know Tesla is. Almost every other automaker is holding the EV cards very close to their vest. They don't want
Mhm.
you to know how much money they're losing,
Yeah.
which is what makes Ford's decision so much braver to go ahead
Mm.
and air their laundry and say, "Hey, here's how much money we're losing per EV we sell." Maybe that'll encourage other automakers to follow suit. We'll have to wait and see.
Yeah. Ooh, I love the way you compared it to today because yeah, it's one thing to say, hey, they're catching up. This is what Tesla was doing in 2015, but what matters is it's 2022, and Tesla is making tremendous amount of profit, and they're selling tremendous amount of EV electric vehicles. And if you believe what we showed at the very beginning here, the transition is happening. It's happening faster than we think. Uh, it's one thing for these guys to try to get into the electric vehicle business, but they need to show profit and they're not. So here's another table that you shared with me. Maybe you can explain what this is about. I'll try to make it bigger.
Yeah, so I don't want to get the name wrong of the Twitter account that sent this one out. It was Chipadelphia on Twitter that sent out this table. Really eye opening in terms of Tesla versus Ford over these first couple of columns that you're zoomed into.
Mm-hmm.
So we've got almost all the numbers needed to fill in this table now, except for the gross profit line, where Chipadelphia filled in undisclosed for those items and NA for the gross margin percents.
Mm-hmm.
But yeah, Ford's total revenue is a lot bigger than Tesla's is still. Just because they're moving so many more units. Tesla's revenue per unit is a lot higher than Ford's is. And Tesla's gross margin is a lot better in total already, even though Tesla is only selling electric vehicles and Ford sells
Mm.
almost entirely fossil fuel vehicles and hybrids. Very few electric vehicles as a percent of their total sales mix. So their EBIT is a small number as a percentage, right? Tesla's EBIT margin about 17% last year. Ford's was 6.6%. That's typical for legacy automakers. They do make, you know, mid single digit profits, and that's considered okay for an automaker. Oh, yeah, the deliveries are on here for the electric vehicles. So you can see
Mm-hmm.
Tesla up over 1.3 million. Ford is growing, but from a very low base.
Yeah.
So from only 61,000 to 96,000. So they're growing their revenue, but the EV EBIT is getting worse for them. So What has happened between the revenue line and the EV EBIT line? It's gotten hit with a ton of costs, right? So the cost had to be 4 billion. That's the difference between 3.1 and negative 0.9. That grew to 7.4 in 2022. 5.3 billion of revenue minus 7.4 gets you down to an EBIT loss of 2.1 billion. So the costs are growing faster than their revenues. That is never good. And that's how you get a worse EV EBIT margin. Yeah, so they went from losing $15,000 per electric vehicle they sold to losing almost 22,000.
Yeah.
That's pretty terrible. When Tesla is making over $9,000 profit per EV sold.
Gotcha. Yep. And this is numbers that Ford is showing because they were transparent and shared it, but very likely the others, Volkswagen, GM, Toyota, they're very likely in the same position. Do you think
Yeah,
so?
it's reasonable to assume that they're in a similar position. Yeah. And if you scroll over to the right a little bit, there's a couple of other automakers shown on here, Rivian and Lucid, and their numbers are worse than Ford's. They're making only
Yeah.
electric vehicles, and they're making them at very low volumes. Only 4,000 and 20,000 EV deliveries, respectively, but the losses per vehicle are enormous for them. If you thought it was bad that Ford was losing 14 to 20,000, Lucid and Rivian losing hundreds of thousands of dollars per vehicle they sell. That is not good. They need to ramp up. They need to get past their break-even point, and it's not certain that they will because the market hasn't shown a lot of demand at their prices, but they don't really have the ability to raise the price to the point where they would be profitable. So those companies are in trouble.
Okay, so there's this really wonderful clip that I saw when Elon Musk was being interviewed by Tesla owner Silicon Valley, and he warned that Rivian and the other car manufacturers they need to do massive cuts. They need to cut their expenses quickly, otherwise they will go out of business. He's been warning Lucid is not going to be long for this world, and the reason he said this is that he explained the reason, which is that it's one thing to create a product, a car that is desirable, and it's something that is tremendous value for your, like, you're going to get so much out of this thing. And so so that's what they've been doing. They're creating a car, but they're pricing it they keep raising the price to be able to cover their costs. The problem is it goes beyond the affordability. And once you get over $100,000 and you're selling a car for that, it's exponentially lower the number of people. It's like you saw here, handfuls, maybe 10,000 people in the entire US will be wanting to buy that car. It's exponentially down every time they raise the price. The issue is that their cost to build this is so high that they need to raise the price. And if they can't figure out how to reduce the cost of manufacturing, then they can't reduce their price, and then they can't sell beyond. And so, they seem to be what he said, basically painted into a corner. They can't get out of this unless they figure out a way to cut costs. And in the same way, the OEMs, the ones who are burdened by the ICE cars, they also can't produce an electric vehicle at a reasonable cost. And this is where the competition's coming. Folks have been saying Ford and GM have been in business for 100 years. They have 150, I think somebody said Toyota has 150 factories. What does Tesla have, right? 3. How are they going to do that? They've got expertise. And I think what we're learning now is that these OEMs cannot take their existing factory and retrofit it. Or if they did retrofit it, it's still the same cost as building a brand new factory. And that's why you're seeing the cost so high, right? What's your analysis of where are the expenses coming from? Why are these Ford, as you saw, why are the expenses so high?
Well, when you're selling at a very low volume, it's very hard to make a profit. So in Tesla's secret master plan, part 1, Elon laid out that the first thing they were going to build was an expensive sports car, the original Roadster. Only 2,200 of those were ever made. right? And Tesla lost money while they were making those, but they were
Mhm.
able to use that experience to build a next generation platform that was better and that was at a lower price point. When you reduce the price point, you grow the total addressable market at an increasing rate. And when you increase the price, you decrease the total addressable market at an increasing rate. So Tesla then could make Model S and Model X. Remember, they didn't have competition in the electric vehicle luxury car segment back then.
Right.
So, however many people wanted to buy an electric vehicle that was a luxury car, their options were pretty much Tesla and that's it. Nobody else was making them. Now you've got companies like Lucid
Mm.
and
Yeah, that's
others
true.
trying to enter a market where Tesla has already established themselves as the market leader in luxury electric vehicles. And they have to figure out a differentiation strategy. How do we offer something that people will want to pay a lot more for than they would have to pay to buy a Tesla? What can we do that makes it worth it to enough people to buy our cars instead of buying a Tesla? And they're finding that a difficult product and branding strategy. So yeah, the costs are very high. Like if you in MBA school, they teach you Porter's five forces of competition, and automakers and airlines are the examples they give of high barriers to entry.
Right.
It's extremely expensive to try to get into either of those businesses. It's not cheap to to buy 747s from Boeing and to sign contracts with enough airports that you can offer service that'll make your company big enough to keep growing and expanding, right? Same thing with automakers. It's very expensive to set up factories and to hire thousands of people to make cars. Um, you've got to have a really solid business plan, and you've got to be bringing something to the market that the market wants to buy instead of what the existing uh, companies already offer to the market. Those are high barriers to your success, and it's the reason why almost every automaker has gone bankrupt. Every
Mhm.
American automaker has gone bankrupt, with the exceptions of Tesla and Ford. Elon is fond of saying.
Yeah. Okay. And then I love the way you did that. You did a very good, you just articulated kind of the nice wrap up of what's happening in the industry. And it's really hard for these, not only the pure EVs, but also the uh, ICE cars, the existing OEMs. And then Tesla is now scaling, creating profit that they can afford price cuts. And when they do these price cuts, it's a death now for these companies. And so let me just share this. You share this. Ford Cap had this tweet just a few days ago, and I think he's said this quite nicely. This is his key thesis, right? So Tesla's cost structure and scale advantages continue compounding, which is we saw that it's growing, while the legacy OEMs are becoming less profitable as their mix of lower margin EVs increase. Pricing wars are now amplifying these issues for the incumbents. Um, and he said, Tesla is structurally better positioned to maintain a lower average sales price than peers, right? Because they're going to keep cutting prices, higher margins that are expanding while competitors' margins shrink. And then as they have greater EV scale, integrated distribution without requiring the dealers and the supply chain, less expensive batteries, no union or legacy asset burden. I mean, it's just at this point, their success, Tesla's success, is going to cause these OEMs to they're already struggling the way it is now, and it's just going to be unmanageable, right?
Yeah, Tesla's putting huge pressure on competitors, and the OEMs do have this headache of dealerships. It is not just a middleman, it's a noisy, problematic, complaining middleman when you have to sell everything you make to dealerships. They don't want to. They don't want to cut their prices to compete. Um, Tesla has the ability to cut prices because they're continuing to find cost efficiencies in manufacturing. They're innovating with structural pack, with front and rear castings for vehicles. We saw um, in Tesla's recent presentations, they intend to make Cybertruck in a different way than people have been making cars for 100 years. It's not going to be on an assembly line. It's going to be in workstations. They're going to have increased automation. They're going to be reducing the labor cost per vehicle. They're going to be increasing the efficiency per square foot of their factory. These are innovations we don't see competitors matching. And they're going to fall further and further behind Tesla's ability to drive down the cost per vehicle produced, which allows them to continue cutting the price and increasing their market share, driving down everybody else's market share through selling a better product, a product the market wants to buy more.
Okay. And I think I should emphasize, I think that it's like Tesla's success and ability to cut prices does matter. But even if they weren't able to cut their prices and improve their margins, these ICE cars would have struggled anyways, and they would have failed anyways. But because Tesla continues to be able to do cost cutting and efficiencies, they're able to reduce the price. It's just going to accelerate that. And this is a really nice one additional point by Ford Cap. And he said that auto OEMs, they're actually purposely limiting their sale of their electric vehicles, right? Their supply of that, because there are implications on their financing divisions. Earlier this year, the Kia CEO admitted to controlling supply, which artificially boosts residual values. So they purposely are trying to not release those cars, right?
Yeah, I just sent a tweet this morning. Maybe I'll try and share my Twitter app. I've got a window open. Let me hit share on this. See if you can see the Ford credit slide here. So this was slide 19 from Ford's deck to end last year. If you look at this second bullet here, credit losses remain low, delinquencies have normalized to pre-pandemic levels, but strong equity values have resulted in low actual losses. So what's this waterfall chart over here doing? It's showing you for Ford Credit. This is the financing arm of Ford's business, the division that loans money out. A year ago, in 2021 of Q4, they made $1.1 billion out of this division. And this year, they only made $0.2 billion. What went wrong that accounts for the difference? Everything.
Wow.
This waterfall chart is going the wrong direction. Everything is down. Volume, mix, margin, credit loss, lease, residual, other. It's all unfavorable year over year. And what they're saying is they're intentionally keeping their production volumes low to try to prop up the equity value of their leased vehicles that are going to be coming back off of lease. They're going to have to sell those. And so they don't want to flood the market with lots of new cars that are attractively priced. They would rather conspire with Hyundai and other companies that are doing the same strategy to try and hold back production levels so that they can keep their financing arms from losing money on the lower resale value of those vehicles they have to take back off lease.
Okay. Well, that was wonderful. Thank you so much, James. You gave us, real numbers. We're actually tracking the health of not just Tesla, but we looked at comparing it to 24 different car companies. We looked at deep dive into Ford and GM, and we're showing a little bit of kind of the struggles that these ICE manufacturers are making. They're not making money. They're heavy in debt. They have struggles with, we already know unions, but certainly we're seeing here financing and their ability to create a compelling electric vehicle. So is the competition coming? It's still, we're waiting to see, but it needs to come sooner or later. As we showed earlier, we showed this graph of how quickly do we think that the demand for ICE vehicles is going to fall. And you're one of the only people, James, that can actually show the actual detailed You spend ridiculous amount of hours. We did an interview
That's true. I
before.
do.
We spent
Yeah.
it. We did an interview with me and you before where we actually went through 32 spreadsheets. That was
Yeah.
fun.
I do. I do spend more time on Tesla than I probably should. Guilty as charged.
But we appreciate you, James, because you're one of the only people that shows us real numbers, real financial metrics, and you've got projections. Folks, follow him on Twitter at I cannot underscore enough. I'll put his link to his Twitter account. He's got his YouTube channel, James Stephenson, and he's got his Patreon because he reveals those information. If you're a Tesla investor, this is what you need to know to keep track of what's going on. And like I said earlier, and I'm repeating so many times, he's the only person I know that does this in this detail, and his forecasts are pretty good, pretty accurate. He's one of the few that can get it right. But he said, rule number one with forecasts, always wrong.
Yeah.
But he's closer than most people. So.
You know at the outset, whatever you forecast, it will be wrong because that's the first rule of forecasting. But the second rule of forecasting is be less wrong. Learn. Learn from how you've been wrong and do better in the future. So
I'm going to hold you to that, James. I'm going to need you to create me a table, a spreadsheet that shows your accuracy, and it has to become less wrong. Maybe get the margin better.
Yeah, I do publish those after Tesla puts out their earnings. I do my own waterfall charts, and they look a lot better than the one I just shared with you from Ford.
You're better than Ford. Your own accuracy is better.
Yeah.
Okay. Thank you so much, James. Really appreciate your time today.
Yeah. Talk to you later.